Thanks for joining us at XM.com for this special report. I'm Christina Marujas. With me today is our investment analyst, Stefanos Economidis, who will introduce our new weekly post that aims to help traders locate instruments that might make big moves in the coming sessions, the Implied Volatility table. Hi, Stefanos. Could you please explain what is implied volatility and why is it important?
Hello, Christina. So let me break this down. Implied volatility or expected volatility is a forecast of a likely movement in a financial instrument's price, which is derived, of course, from market-traded options. The instrument could be an individual stock, a commodity, an equity index, a currency pair, or even a cryptocurrency. For traders, implied volatility is important because it provides insights into what the market thinks about an asset's upcoming movement, whether it will be large, moderate, or small. Expected volatility is also useful as it offers a range of prices that the security is anticipated to swing between, and therefore helps traders select potential entry or exit points. In general, as the expected volatility rises, the probability of a sizable move up or down in the instrument's price increases. However, implied volatility does not predict the direction of an impending move. Another thing that traders should be aware of is that expected volatility should be compared with a specific instrument's historical values. Riskier assets, like cryptos or stocks, will almost certainly have higher volatility than major currency pairs.
I see. Could you provide an example of what information the table is going to provide for each instrument?
Yes, of course. Let's take a look at the output of our volatility table and describe each variable separately. So we begin with a specific trading day and the closing market price of each examined instrument. Then, for each instrument, we provide the level of its implied volatility and the upper and lower boundaries of its 30-day range. In this way, the reader can easily understand whether on that particular day the instrument is considered hot or quiet relative to what it has been doing in the past month. We do this by comparing the current level of implied volatility with the recent past through the use of deciles. Put simply, being in the highest decile, 6 and above, means that current implied volatility is higher than the values of half of the previous 30 days. Therefore, this decile figure shows some elevated chances of bigger moves going forward in the future. It's worth noting that the higher the decile number, the higher the chances of big moves, according, of course, to the market's forecasts. Similarly, for deciles 5 and below, the market's view of chances of big moves is relatively lower. We also provide the deciles from 7 days ago for comparison purposes. For instance, a change of decile from 1 in the previous week to 3 this week may still show less than average expected volatility for a particular asset, but its expected volatility is picking up. Finally, we also calculate the 7-day return, which is also important for traders to have in mind.
Stefanos, before I let you go, how are we going to identify increasing or decreasing volatility?
Now let's see a hypothetical example of two pairs whose volatility moved in opposite directions to totally understand this. On the one hand, it's clear that expected volatility for euro-dollar in the examined day is near the upper end of its 30-day range, as it has jumped from decile 6 in the previous week to decile 10. In other words, the pair's volatility shifted from neutral to extreme levels, hinting at a higher probability of a significant move in the upcoming sessions. On the other hand, Euro-Yen seems to be experiencing lower volatility compared to what happened on the same trading day in the previous week, resulting in a decline from decile 6 to decile 2. Thus, the pair's volatility shifted from average to low levels, suggesting that the price is more likely to remain more or less flat in the upcoming sessions. That was it for today. We hope that this tool will enhance your trading experience and provide insightful information about relevant movements in major trading instruments.
Stefanos, thanks so much. It sounds very, very interesting. So be sure to check out our website, xm.com, every Tuesday for the new weekly implied volatility table. Thanks for watching.